We're snorting cap rates and shooting up cash flow here at Deal Junkies. All right, guys, welcome back to Deal Junkies. We're in the studio today. I'm Gabe Johansson here with Trevor Howard.
Oh, we're wearing matching shirts.
No, yours is more expensive than mine. Oh. That's bougie.
Bougie.
We do kind of match, though, huh? You're my kid.
Yes,
it's father's son. Take your kid to work day. And Mike Nuss is here, too. What are we talking about today, guys?
How to buy distressed real estate.
I thought we were going to do an econ update.
So you wanted to talk about buying distressed assets in 2025 and do an econ update because you said the Fed dropped interest rates, but rates went up.
So what do we want to talk about first? Should we talk about the Fed?
The interest rates, so I'll take a quick nap while you guys talk about it, and then we'll
Why don't you ask questions, Trevor, since
Okay.
you don't follow this?
Okay, yeah. So what happened, Mike? You guys are talking about
It's so fun to
interest
talk
rates.
that way. It's so much more fun to weave a bunch of stuff into like one crazy story that people can't figure out.
So Wednesday, the Fed cut.
Let's start with distressed real estate.
No.
Let's
Tell me
talk
what
about
happened.
The topic of buying distressed real estate in 2025.
Tell me what happened with rates. So Wednesday, what happened?
The Fed cut quarter point. Base rate's a quarter point.
Okay.
Lower.
But I have a question.
The overnight funds rate.
Overnight funds rate.
Okay.
Which
from what to what?
Like
roughly.
5 to 4.75.
Okay.
4.75 to 4.5, something like that.
It has a little spread.
Okay, and then
So it went from 5 to 5.25 to 4.75 to 5. Is that right?
Yes.
All right.
it went down.
It went down a quarter
Okay,
point.
and then the 10-year went up, is what you're saying?
Yeah, the 10-year went up a quarter point. This happened with the last three rate drops. The 10-year Treasury goes up when they lower the rate.
It's because it didn't lower as much as people were
As
expecting.
much as people were expecting.
It has
And
nothing to do with that.
it's forward guidance, right?
It's the words that came afterwards, which is essentially we're cutting now and we probably won't cut for a while.
They just said they can take their time if they need to. I don't think they really used a lot of hawkish words, though. They just looked at the dot plot, and the dot plot showed 2 cuts next year instead of 4. Right?
It was more than the dot plot, though, because the verbiage that Powell used was more like pivoty, which is
we're going to pause now.
Yeah, because early on last year, what people missed was they said we don't care about the job market. We no longer care about inflation. We just care about the job market getting bad. And it never really appeared. And the reason rates started going down, the reason they cut by 50 and 10-year yield got down to 3.6 and 7, it was because we had a huge jobs revision. So this whole period of time, these job reports are not real. The economy is worse than the reporting. The economy is worse than reporting. And then everything happened where inflation got sticky at the beginning of the year. It started going down from the early to the summer. And then during that period of time, we had really strong jobs reports. And then as inflation kind of bottomed out, we had a huge jobs revision. We had a Fed pivot. Everything started going in the way of, great, we're going to be able to sell some real estate. Interest rates will be where we want. We can start taking action again. And then we got close to the election and it was obvious Trump was going to win. And we had the Trump trade. And then he did win. And then that just kind of stuck everything with the 10-year yield in the 4.25 to 4.45 range. We got back down to 4.2, was trending to 4, and then we had the cut, and then it went back up to 4.5.
So explain to me the jobs report and how it works super high level.
Yeah, well, you get reports are based off of surveys, and so the initial report isn't based off of data, it's based off of assumptions, and then prior to that report coming out, there's bets made based off of assumptions. And
it's the jobs report is just unemployment numbers.
The first one that comes in is through ADP, and they're pulling data through payroll since they're the largest provider of payroll services. The second one comes in and it's more government based, and this has to do with I'm guessing
Bureau of Labor and Statistics, I think.
Yeah, there's statistics based on who paid taxes that month and who filed unemployment claims and so on and so forth.
And they're giving you the total number of employed people.
So what they're looking at week by week is how many additional people have filed for unemployment, how many people are still on unemployment that filed in weeks prior. Okay. Basically, how many people are we at full employment or not? So the Fed has, they have 2 goals in mind. One is full employment and the other is price control. So they're trying to keep inflation down, which they said it was sort of pivot talk, you say a few months ago, when they said, now we're going to turn our focus to our second mandate, which is full employment. They sort of said we're going to take our eyes a little. They didn't say we're going to forget about inflation. They're just going to now turn and start paying more attention and weight their decisions more on employment. Correct?
Yep.
So now, like today, 2 days after, which I don't understand why they do this, but the Fed had their meeting. They lowered the rate. 2 days later, today, this morning, the PCE reading came out. Yeah. And it came out lower than expected.
Today it did? That's great.
2.4.
What's the PCE reading?
That's actually the preferred, because that's the producer's.
Yeah,
it's the cost of production.
Consumer price, or no, it's not CPI.
Price. It's
a PCE. It's the one that the Fed
cost something, but it's the cost of goods. Think of it that way. Okay. So the cost to provide supply. That's very Fed prefers that measure because that's a leading indicator to what costs are.
Why do they have their meeting 2 days before that report always comes out? Shouldn't they? Do they already have that data in front of them?
Fridays and
Wednesdays.
Okay, yeah. So better answer your question. So jobs reports, you have job list. What they're looking at is new claims. They're looking at how many people are employed, how many jobs are out there available as well. So it's not just unemployment rate. It's not just jobless claims. Okay. It's initial claims. It's ongoing claims.
How has it been trending? We've been having more people or less people?
It's soft. It's still a strong jobs market, but it's not running hot. When it runs hot, that becomes inflationary. Because
when you say hot, everyone's employed or everyone's unemployed?
Everybody's employed.
So there's more dollars.
So imagine it's just supply and demand, and so now you have more demand for employees than you have employees, and so you have to pay them more.
An unemployment rate is a good relative way to look at it. So as we started the change of monetary policy, we were at 3% unemployment. We got to 4.1, 4.2.
Okay.
And the huge revision was, I think, September or August, 814,000 jobs. So, and that was for Q1 2024. So all those hot jobs reports from Q1 2024 were 800,000 jobs
lower.
High. And when you look at it, it'd go from, I think, whatever it was, 3.5 to 4.1 was 1 million jobs. So going into this year, it was if we lose 1 million jobs, that gets unemployment to where we want, which is still historically pretty damn low. Right. But that means we're taking
They wanted to lose jobs?
Yeah, because you have to fight inflation. You have to reduce purchasing power based on the Fed's tools.
Okay. But you were just saying their goal is to have full employment.
Yeah. But full employment is like 4% unemployment, right? I don't know. What do they define?
They have a target that they try to stay at, and they don't try to go below.
You would never want it to be zero. Zero is not full employment because zero is crazy off the charts. Wages are going too high, which bleeds into all the other products.
So they're trying to just like inflation. They don't want it at zero. They want it at a number, a target.
Yeah, in a vacancy rate, if we have 3% market vacancy rate, rents go up too fast. People can't keep up. That's inflation. Right?
Gotcha. Yeah. Okay.
So in order to fight inflation, you have to get job loss. That's based on the tools they have.
Okay. So jobs reports are coming in. Unemployment is increasing or decreasing?
Yeah. So that might be what saves us. So as the Trump trade kind of went into effect, what also happened was now inflation reports all came in above expectations months in a row. So it was, okay, Trump trade in effect is based on an inflationary
When you're saying Trump trade, what do you mean?
So essentially, yields were under 4 ever since the Fed cut up until about 4 weeks prior to the election.
Okay.
And all of a sudden, they went from like 3.8 to 4 to 4.2 to 4.4.
Yep.
And that was the Trump trade coming into effect. It was essentially money coming out of the bond market, going into Bitcoin and the stock market.
Okay.
Right. So it's a reallocation of the wealth that's out there.
So coming out of the bond market drove the price of bonds down
yields up,
which caused the yield to go up.
Correct. So even though the Fed lowered the rates that banks pay overnight, because there's now another allocation of money. So essentially the Trump trade was starting to work its way back out, and money was going into the bond market and yields were getting down to 4%. And then now these words are, we're really concerned about inflation. We've shifted our view from employment now to inflation. And so what that means is essentially we don't feel like we have the ability to lower rates. We have to have a tight monetary policy. And that's not great for the stock market. So now you're seeing it in the stock market now. Plus you have the government shutdown, the politics around that happening at the same time. So you have a PCE report that comes out better. So here it is just we haven't had any data to offset an inflationary environment since the Trump trade started. And so until we have something that says, hey, this inflation report came in lower than expected, or this jobs report came in lower than expected, something that is opposite of inflationary, we're just going to be stuck in this higher for longer period of time. And then that parlays into 2025, which is, are there going to be distressed deals out there to buy?
Yeah, I have one question before we dive into that. So the overnight rate was lowered, so banks are borrowing money at a cheaper rate, but they base what they lend to us typically on a 5-year or 10-year index. So they're,
I think what's happening with
taking bigger spreads.
Yeah, so that's to what they're lending to each other to balance out their own balance sheets. It's not necessarily what's going out to the public, correct?
So because think of it overnight. Here's a bank does a lot of banking during the day, and overnight they are either positive or negative.
Books, right?
And so this interest rate. So don't think of it as a cost of money. Think of it as this cost of money changes allocation. That's all it is. Is when it gets really high, they're not putting it into the market. When it's really low, they're incentivized to put money into the market. And that's what it is. It's allocation, not cost. Cost doesn't matter. Cost is a wipeout to make books even overnight.
I listened to a CEO of one of the largest home building companies yesterday, and she was talking about how, they don't really even need rates to come down. They just need the 10-year to stop spiking and dropping and spiking. Like, we need stability, really, is what we need. And the 10-year normally doesn't bounce around as much as it has been, right? I mean, it's just been super volatile over the last couple of years.
It's 4.51 now.
4.51. So it dropped. I think it dropped 6 or 7 bips when the PCE came out this morning, which is a good sign. But everybody is forward thinking, and they're hedging their bets on what they think the Fed is going to do. And now, people are talking about how Trump coming into office, his, removing regulation, taking away, lowering taxes, doing a lot of these things will be inflationary unless they can get the government to stop spending as much as they're spending. And then potentially we could lower inflation and we could all make more money. So that would be a dream come true.
So do we get to the government shutdown conversation?
Yeah. Well, one other side note. So we made a bet on our storage unit 2 months ago or so. That rates were going to go down.
Yeah.
So we didn't lock. And then we passed on a 6.1 and took it to like a 6.7 rate. But I would have made that bet again, wouldn't you?
Yeah, it felt like that was going to happen. I don't know if...
but what's your float period? Don't you have a period of fixed?
So... lender forgot to lock it or something, or I thought.
You mean in just the run up?
We thought we were going to get to lock and only get to go down or something. Something happened where we
thought we had a ceiling and we had a floor, or maybe we thought we had a floor. And we had a ceiling.
We thought we had a ceiling, and then they're like, "No, that's the right floor." Like, why would we lock in any scenario if there's a floor? That makes no sense.
Why would we lock to protect
lenders,
you?
Fucking lenders and their soft credit pulls and their locks. They don't know shit. Sorry.
They know.
They know.
They know that nobody else is lending, so they can do that to you.
So do you want to talk government shutdown, then we talk 2025?
You were going to talk about the government shutdown. What does that mean?
It's interesting because it's a spending package, needs to be passed or else we go into a shutdown.
Omnibus.
Happens all the time, right? And the politicking right now is essentially, prior to Trump saying anything, prior to Ramsey reading the actual bill, essentially there was a bipartisan agreement to sign the spending bill and we're fine. And then the office, the Doge office, government efficiency.
Is that a thing now?
It will be. It's not yet.
It's not yet, but they're acting. So that's whenever you're in elect, you start taking action as if you are. And so, I saw a pretty long video of Vivek ripping the bill apart, 1,500 pages, and editorializing the shit out of the video based on what people do when they influence people and projecting his own opinions and editorial into this bill. There's a lot of pork. Some stuff should be pulled out. But what's interesting is, so they're saying, hey, now we have leverage over you because we're coming in. So the Republicans in the Senate, we have leverage over you. If you want your job, especially because now we have Elon who will bankroll your opposition in your future upcoming elections. So there's leverage over the voters of this current bill, even though they are not currently in office or have any power. And so they've essentially used that to block the bill. So Republicans are not voting. So now we have no spending package, which means we're facing a
federal
government shutdown.
Okay.
And so what you pander in politics, what you do, so the Republicans are saying, look, we don't want them to spend. There's all this wasted spending. They're ignoring the fact that, well, we already agreed to it. Now we're just backtracking because new leadership says we shouldn't agree to it.
Okay.
Which all makes sense because I think Trump was elected because government is out of control and we want some accountability when it comes to spending, yada, yada. So that makes sense to me. Which is, hey, there's a whole bunch of pork in here. We need to start getting this out, and we're not going to sign it until we remove actual costs, because that's what we ran upon.
Okay.
But then you have item number 3, which is, it also says in here that the debt ceiling limit is going to get raised in 2027 under Trump's legacy. So Trump wants that to change to 2025, so that way it's done inside of Biden's tenure. So he wants the actual debt ceiling to be lifted now while Biden is actual president.
Why?
He wants the dollars to be spent or the allowance for the
No,
dollars?
just the allowance to be increased. So the debt ceiling can be increased. Yeah. So that's in complete contradiction to item number 1, which is there's a whole bunch of pork in here. We don't need to be spending this much money. We need to stop this bill in order to spend less. Okay, then why do we need to increase the debt ceiling? Right. So there's just a contradiction of politics there, which is complete bullshit, which then goes to, okay, so what is the Doji office really going to be? Because if they have a recommendation is against what Trump actually wants, which is against his legacy, which is against his ego, which is, no, this is throw this on Biden. This is going to be Biden's issue, even though it doesn't matter. And I want to get something passed. So I wrote a post on it on Facebook, and my thought process is I hope it's a negotiation. As someone who negotiates for a living, I hope that they're just saying, hey, we're going to throw this debt ceiling date here as our little carrot that we're going to ask for this. We'll take it away. We'll agree to 25 and then hopefully remove some spending from the package. And if that happens, that's ultimately what Americans try to vote for.
Aren't they going to have to raise the debt ceiling?
Yeah.
I mean, they do this government shutdown, raise the debt ceiling thing like every 6 months, it seems.
So what I just said is the positive way to look at it is, hey, this is just a ploy of negotiation to ultimately get what we voted him for. But I think, and this is where like my dad, the people that hate Trump are more like, no, they're just going to spend anyways, which is what we believe is really going to happen. So we see, this is really a kind of cool thing to see happen now is we really get to see is, do they care? Is it actually going to be about spending or is it just going to be about politics?
So how does this affect us?
Well,
because that's inflationary. It's going to affect our interest rates significantly.
Interest rates, commercial real estate is very sensitive to interest rate. So for about every point of interest more we have to pay, a cap rate will drop about 50 basis points.
And the other part of that is prior to COVID, interest rates were less sensitive to this stuff. Because we're so full from the max of what our assets can hold value-wise, equity, right? Think about prices we're putting on things, the multiples in the stock markets, the cap rates on the real estate, the interest rates. There's so much money in the marketplace, and interest rates are so maxed out that any increase in interest rates sinks asset values, stops transaction volume, is very recessionary. We're up against this breaking point that prior to COVID, we could mess around and interest rates wouldn't have this effect and interest rates on their effect on real estate wouldn't have this effect. So it's like these layers of stress in the system. And that's why we need higher for longer and to get some money out of the system, just so we can lower costs to make the system less.
One thing I will say, we talk about, the risk adjusted pricing in our interest rates. And I think that what I'm seeing, if I'm not mistaken, is that there's less risk pricing. Like there's less delta in there for risk pricing. So the interest rates,
bank and
on larger loans specifically, when you talk about GSE, agency debt, Fannie and Freddie, their average loan closed in Q3 at 5.8%. So their spread is starting to shrink down. The risk spread is starting to shrink. You're even seeing it a little bit in residential, although right now I think it blipped up again.
I thought they used to take 150 to 200.
It used to. If you look at a historical average, it's about 160 bips.
Right now they're at like 240.
For the last 2 years, they've been at 300.
Yeah. But that's because you're comparing it to a period of time where the Fed was a buyer. Now you're comparing it to a time where the Fed is a seller.
Yeah. So the market is starting, at least lending feels like it's starting to loosen up or thaw out. Not loosen up, but thaw out from the deep freeze that it's been in. And it seems like for those lenders who are lending, specifically agency, which is government-backed debt, the risk pricing is coming down. So I think I talked to a big syndicator the other day, and he said, if we're at 6+, anything with a 6 handle on it stops business. We get down to 5.5, 5.75, we can make deals work because cap rates have come down about as far as they're going to, or they've gone up about as far as they're going to go. Values have come down about as far as they're going to go. And owners, unless they're super distressed, which we'll talk about here in a minute, are mostly holding on. They're doing workouts with their lenders to pretend and extend and to push those loans further out so that they can refi later. There will come a time, and there's talk that lenders are getting impatient and they're wanting to have those loans pay off so they can recycle that capital, especially when we get to the point where we're not all wondering if tomorrow it's going to be significantly lower. And that's one of the things I like about, the dot plot saying that we're going to drop 2 times instead of 4 next year, is it actually brings people off the sidelines because a lot of people are waiting for the rates to drop, just like Trevor was saying. We said, let's not lock because rates are going to come down. We know that eventually rates are going to come back down, but it's not going to happen very quickly. And so we can transact today knowing that we don't need to wait a few months before we do a deal because we might get a better
How do you say you'll
rate.
know rates are going to come down? I mean, it could.
Well, we're still in a low rate environment. Once this all shakes out, we're still burning off the COVID nightmare. They pumped. I don't know. I don't know what'll happen next.
Paul Curley told me when I saw him on the bus. Dude, I was riding the bus to Bend, and Paul was just sitting on the bus.
way.
So I talked to Paul for like 3 hours. He told me the real estate market's about to explode. He said, we're about to see things that we've never seen before.
He's never been wrong since I've known him. Anything he told me was going to happen happened.
Explode is in crash explode or
upward.
Upward, yeah.
Yeah. Oh, he says he's more excited about buying real estate today than he has been in his whole entire career.
I'm excited about an extended buying window. It sucks to be a seller right now.
Yeah, well, he doesn't sell, so that's probably why
he told me he was done buying also, other than with you.
Yeah.
Well,
and then I called bullshit on him, and he just laughed.
Based on what you had all said, it's a good thing to put into context, pivot, and depth or spectrum of it, right? So we pivot again. This pivot is essentially the same thing as March 2022. Which is, all right, we're now fighting inflation. That's what they did in 2022. But there's a depth to how things happen. So in March 2022, they threw everything they had at it. In December of 2024, they essentially pivoted again. We're fighting inflation again. We're no longer, we're concerned about the job market, but we are more concerned about inflation. So that is that same type of pivot, but the depth of it is significantly less.
Yeah, you had talked about before how the markets do the Fed's job for them. Mm-hmm. And you wonder sometimes how much of this is...
I was thinking that this
morning.
They're
like, we don't even need to do anything because we can just say something and the market will do what we need it to do.
And it looks like 4.5 is the new 5. Like we were 4.51 yesterday, or this morning 4.56, and now we're back to 4.5.
In the summer, we were thinking 4 might be the new 5.
Yeah, we were hoping.
That was wishful thinking.
We never said that, though. We copied the 4. Larry Fink's 4.5 is the new 5, or Pimco's guy, and then just copied it and never changed. But what I wanted to get is the lender side of it. What you essentially, in July 2022, lenders pulled back significantly. Rates went down, leverage went down, points went up. Everything went against the developer. That we haven't seen any of that at all. The lending packages have not changed. Our quotes have not changed. The liquidity of lenders have not changed. If anything, the lenders that I'm talking to right now is we're getting more money. We need to give more loans. And so the butt pucker effect is still at that it's released from the pre-election pucker. It's still puckered.
Aren't they?
But it wants to release.
I mean, they have to lend to make money.
Absolutely.
And they haven't been lending.
So here's the markets don't like uncertainty.
They don't have to lend to make money. Lending is a part of making money. Buying assets at a huge discount is another way to make money.
Yes.
So there's a period of time where just
how would they buy assets at
you don't
other
think
people's
freaking
debts?
big liquidity money is getting really good assets right now?
I mean, as a bank,
as a bank, what do you mean? I don't worry about banks are small in the macro world of money. Banks are small. Think of insurance companies. Think of BlackRock.
Just buying things at discounts and distress.
Yeah, exactly. Those are the politicians are puppets on strings. That's why they change sides on what they vote for. It's the money on both sides. They manipulate both sides. And it's the bigger ones that are the ones that you want to look at.
So you're saying those big players, but they're just buying from other big players?
No, they're just, think of it this way. What did BlackRock do in 2010 through 2018?
When they were buying houses?
They bought every single family home they could. They packaged it up and then sold it to the retail market via an ETF. They essentially cashed out all their real estate. They bought lease option holiday home. They bought all these things, sold them all to get all their capital back. Real estate's just going to be cheaper here for them very soon, right? And so it's just it
already is.
They're pumping down.
They're closing deals left and right the last 2 quarters. Yeah. So that means it's coming back. That's one of the reasons Paul's excited, is because he sees the big dogs
getting their cash ready, and
they're doing big loans. They're buying big portfolios. There's a lot of big stuff happening.
And that money moves fast or sooner because it takes them longer to move it.
So for us, we're out buying smallplex or small apartment complexes or value add. Let's talk about 2025. Where is the opportunity going to be, and how do we find it?
It's the same fucking thing, dude. Because nothing's changing. The level of distress. So look at who's transacted. Transaction volume has been down significantly, right? You think there's essentially like 3 parties of transaction. You have the sellers that have owned property for a long time, that have a lot of equity, that have a duration of ownership, that are just okay with the reality of where their value is now versus where it was a couple years ago. You have the 1031 buyers, the estates, the natural movers of money that are just like, there's a seller that's in reality. I don't care if they're distressed. I just need to get this transaction done. I'll pay market value. That's like a percentage of the transactions out there. And that is the best example of what market value is. Then you have the people that are like, hey, I don't need all my cash, but I want to maximize my equity. So I'll be creative. I'll do the seller financing. I'll leave equity on the table to get a buyer to transact. I just won't get that. So I'm trading maximum equity later for less equity now. That gets the creative deals going, like what you guys have been doing. Outside of that, the only distressed deals are ones where the developers have lost equity, the banks have no equity, the developers walked away. It is a non-performing asset. And so it's really only the non-performing assets without equity that are actually hitting the distressed market. You could have a value, you could have an LTV over 100%, a performing asset, and you're not going to be distressed because the bank's just going to do it and extend and pretend.
Yeah.
Aren't you going to see the most distress in 26 and 27 because people have 5-year reprices and they just started?
None of that matters.
21, 22.
Here's my take on it. As long as you have a performing asset, you're not going to go to the distressed market. It's just not going to happen.
But it may not be performing at that point because rents haven't increased enough, and now you're taking your rate from 3 to 6.
That's the pretend, extend, and pretend.
And you think they'll just extend that rate? I bet the bank's going to ask for the higher rate, and they're going to have to limit DSCR.
That's in the first wave of it, sure. Yeah, and it may just be making a bigger explosion down the road. I could see that.
Because if you look at the market right now, there's a ton of people trying to sell their properties with their loan assumptions, and they're trying to sell it at insane prices because they're offering 3% rates, but they're all expiring.
But they're not in reality. Yeah,
they're expiring in 27. You have no exit plan.
I see a lot of people. I've got a 3.6 rate. I've been offered a 5.5 to extend. My 3.3 expires next year. I've been offered 5.5 to extend 7 years.
Did you take those?
I've seen people say yes. I mean, I would do it. I mean, I don't know. It depends.
You should
in a vacuum.
negotiate to 5. Seeing what
I'm not.
Logan and I are closing on our first Freddie Mac assumption today. We took over 4% interest only.
How long do you have left?
That's for the next few years, and then it reprices for another 5. But it's good debt for 8 years. We have 8 years of good debt that we likely won't see again, maybe for close to 8 years.
But you have probably like 2 years left, and then you're repricing or something.
3.
Yeah. So that's just long enough where it makes sense for you.
Yeah, and the numbers. I mean, the deal would not make sense without the debt. The debt was.
Does it still make sense at the reprice though? 3 years later.
Oh yeah. You're buying an asset that's still 6 cap, north of 6 cap, but you're picking it up at 4% IO. I mean, it's a good, stable, newer product.
I think you have IO on the term for that actually. I don't know.
I think it is.
I don't think you have a reprice even.
I think there is a reprice in 3.
Also, did you sell?
Your underwriter? You trust this guy?
No, I'm not on this deal. Logan was talking about the other day. Did you sell the Park Place apartments in McMinnville?
No.
Is that you?
I own one called Park in McMinnville that I did not sell, but
I got an article that it was the highest price per door ever sold in McMinnville.
So I met with that guy yesterday in McMinnville, the guy who owns that.
Yeah, who bought it?
Yeah. He's like the acquisitions guy for a big syndicator.
Okay, so
he's out doing his own personal deals, and he loves McMinnville. He flew in yesterday, and he wanted to talk about McMinnville and Newburgh.
Did he want to buy your other project?
I showed him around. I said, yeah, I mean, maybe I don't know that it's going to be a fit, but I showed him some of our assets to see if he wanted to go into them.
So why did he buy that deal? Why did he pay the highest per door ever?
I don't have. Is this like the 37 unit?
Something like that. Yeah, it was. I got an article sent to me about it's the highest price ever.
He just did his first turn. I think his rents were at like $1,200 or $1,300 when he got it. He just did his first turn, rented it in one day for $1,750, 2-bedroom unit.
And he bought it for what per door? Do you know?
I don't know.
Okay.
I don't know the math on it. So he paid. What was the price per door?
I don't know either. I just thought it was it didn't even.
He asked me what we'd want for our stuff, and I said we're going to be approaching $200 a door. And he said, what kind of cap rate's that? And I said it's probably pretty close to a 6 cap. But I mean, it's kind of crazy to see what's happening in Yamhill County when you can get $200, $300, $400 more for a bed, for a 2-bed than you can get in Salem, Albany area.
And so you don't know his model or what he was doing, how he structured that?
He wants to do value add, but lighter lift. I don't think he wants, kind of a medium lift.
And he syndicated that deal, or he just placed his cap?
He probably did syndicate, but not through his big company that he works for.
So why do those guys? He doesn't own the company he syndicates with. He's just an employee there.
He's an employee at a big syndicator, and then he's off doing his own deals on the side.
The side, okay. Because I see some of the syndicators do the side deals, and I always wonder why they would spend the time to do those.
Well, I mean, he wants to have ownership.
That makes sense for him, yeah.
Yeah, when you're working at, I mean, you might get a little piece of the pie, but it's it's just small percentage of the company. I mean, these are big. This is probably multi-billion-dollar company is my guess.
Yeah. Okay, so picking up distressed assets, what opportunities do you see if the banks are just extending loans?
It's the same. Well, they'll be out there again, but it's relational.
Define distressed. Like, do we have a? You're talking about underperforming asset. So if it truly is distressed, it's going to have 20-30% vacancy. It's going to have a ton of capex work. They don't have the money to put into it.
I view the term distressed coming up as in they can't refinance and they have to put more capital in to hold.
Well, so cash in refi.
How do you buy deals in 25, whether it's distressed or not, right? So you can get, I can't even think of, I haven't bought from a lot of distressed sellers lately. The sellers we've dealt with are just, they need to sell. They're underperforming assets.
We're buying a lot from a distressed seller right now.
Who is?
We are.
Oh, yes, we are.
Who is?
So tell me, have you bought? I don't think I've really
divorce.
I haven't really bought distressed.
Estate
has to pay.
Yeah, Stang's buying some really good stuff now from an estate where the dad was a developer, and they're just not smart how they're trying to liquidate stuff.
We're trying to buy one deal right now. Is this considered distressed? So the bank has it, the loan stopped performing. I'm trying to negotiate.
That's definitely distressed.
Okay, I'm trying to negotiate with the bank to let us come in and give me a line of credit for this deal to go rehab it at 100% leverage. But that would be a good deal potentially for the bank, right? Still, if we have an operator,
because they changed from a non-performing loan into a performing loan.
Yeah,
they'll want some deposits to go along with your line of credit. But yeah.
So Jude's negotiating this one for us. We went through the exercise, and they wanted like 2.4 for it. We offered them 1.5 with a $200,000 line of credit because that was the current loan balance that they had on the deal.
I've been involved in transactions that were probably going to go to foreclosure, but the lender was a local lender. It was a local party or nonprofit. They didn't want to foreclose on them, and they went out and tried to help them solve the problem. Rather than doing a extend and pretend, they said, let's go find somebody we can give this loan to and figure out a way to put them in. Paul bought a building like this in downtown Salem where the lender basically allowed him to come in with full leverage and take over because they wanted to swap out take out the bad borrower and put the good borrower in. Mm-hmm. So there are opportunities if you're a better borrower that the lender might just go, sure, we'd rather give you that loan and bend over backwards to make sure you get what you want so that we have a better borrower. They don't want to foreclose. I don't think anybody wants to. It's costly. It's not fun. Like, I don't think the process is good for really. It's not like they're out trying to take these properties back.
Yeah, and that's where track record's really going to matter in this, because it's mostly going to be relational. It's all mostly going to be off mark. The process hasn't changed. You're looking for underperforming assets that you can reduce the expense ratio, make them more profitable, increase the NOI. That's what you want to buy. Some of those will be really easy because the asset's just distressed, and then if you have a relationship and you have a track record, you leverage those two things into an off market great deal. But to get to those, if you don't have the relationships, you don't have the track record, you're still just looking for underperforming assets. You're trying to get a hold of the owner. You're trying to get a hold of the decision.
Same thing we always do.
Process hasn't changed. So the people that have been doing that process for 3 to 5 years, 5 to 20 years, the momentum is there where it makes it really easy in this scenario where you're going to get a phone call with a distressed asset rather than you have to go call all these bankers to find out what's on their
Should I be calling all the banks right now?
I would borrow because how many relationships have you started and not even finished on the borrowing side of it? So you have a huge Rolodex of bankers. You should start with all the bankers you've gotten loans from, which is, hey, you've seen our balance sheet, you've given us loans. Yeah. What is your balance sheet looking up? Do you do you have any distressed assets coming up? Is there anything we can get ahead of? Do you have any property owners you've been talking to that can't refinance that might be able to benefit from how we do deals, how you've seen us do deals? So you work with the relationships that you currently have, and then when that's done, go to all the brokers that didn't give you loans and give them an opportunity to get your business, because you're obviously doing deals, so they can use their distressed portfolio to now go get business because they use that to reel you in when they couldn't with whatever they were offering before.
Do you use loan brokers?
I don't, because I'm small. I am my own broker.
Okay.
That's the other thing for guys like me that are smaller. Talk to all your hard money lenders. Hey, who's failing? They probably won't tell you who's failing, but what are you doing with your notes that are defaulting? Most of them sell their notes, but some of them service them, and they have relationships with servicers, and so you can get ahead of some distressed inventory that way as well.
They don't Precision has that note on that deal, the fourplex deal, and it's accrued $90,000, and they haven't started the foreclosure process. It's over a year past due.
They may get to the end and waive some of that default interest and stuff. Yeah,
but why would they not foreclose and take that back? They just really don't want the deal.
Yeah, the investor makes the decision, not the servicer.
No, well, the lender. So it's past due.
But the investor who actually holds the note makes the decision.
Oh, as an individual, you mean? Do I
They use somebody else's money to fund that loan, and they're letting them help make the decision.
Yeah,
interesting. Okay.
So we do deal with this payout, fucking FCI. They're the worst. Their payoffs are always wrong, and so then I go to my guy who gave me the loan. Look, here's why their payoffs are wrong. Let's get it corrected. We got to go to the investor, and the investor's got to tell FCI to do it this way. And so there's this business day chain of events because the actual decision maker is down the road.
Okay. So if you were me right now,
yeah,
or me and Gabe, how would you go buy more deals?
If I were you guys, how would I go buy more
how
deals?
would you go about what actions?
Exactly what I just told you to do.
Call the banks.
I would call the banks. And then all your brokers, because you have all the broker relationships as well.
You're talking about loan brokers or?
No, real estate brokers, the commercial brokers.
And asking them
have the supply. Yeah, because you just need an army of people talking to sellers. You already have people talking to sellers for you based on your brokers and then all the outside brokers that you've done deals with. Your distressed conversations will probably come from the bank.
One of the things that's going on is some of your owners out there are not necessarily distressed, and their properties may not even fall into that classification, but money has moved so slow over the last couple of years, you haven't been able to really sell much or refi, and so there's a lot of folks out there that just need to get their balance sheet in order and put more cash on their books. And since things aren't transacting and they don't really want to give things away, to me, that's going to be where a lot of the opportunity is. There are several assets that I would sell, but we're just sort of holding off because we don't want to give them away. We've sold a couple of things this year when they made sense, but just like you said, come to grips with this is where we're at. We need the cash. We're doing another deal. Whatever the case may be, we're always doing business. Mm-hmm. But if you don't have to sell over the last couple of years, you wouldn't have.
Yep.
And I think that next year people will be either coming to grips with okay, well, it's not 21 anymore anyway. It's 25, and we're in a different market. And the numbers just that, in your mind, those high valuations, we're sort of it's in the rear view now.
Yeah, we're hitting a floor of what value is. And you can never figure out what value is.
I think we've been dragging the bottom for a year.
Yeah. There's a difference between residential and commercial, and I think it's important. Prices get reported as a median for everything that's sold. That's not how you see whether market's going up or down, because especially in the 1 to 4 unit world, because of the shelter component there. If you actually want to see what's happening to the actual market, cut out all the existing homes, just look at new construction, because that is a commodity and that is sold based on real values. So look at just what builders are doing. Fuck, we've had to cut prices everywhere. We're writing checks right now to sell some units.
Buying down rates.
Yeah, and lowering prices. Yeah, so it was we're trying to keep prices high and buy down rates, and we're slow on, selling stuff slow at a time. And then on a couple of our projects, the dogs in North Portland, where we have a lot of competition, we just lowered them to just.
And
but we're in the middle of winter right now.
When you're saying you're cutting checks, like you're losing money, huh?
Writing a check to probably breaking even, just kind of how we flued out the equity of the portion of the project. But some of them we're losing on. Yeah, we took some losses on projects last year. Yeah.
Do you think a lot of people are buying listings right now, and then prices are just really high in the commercial space?
What do you mean by buying? Oh, you're talking about brokers buying listings?
Brokers buying.
So, terminology is like brokers will go out and take a listing at a high value just so they can get their name on the listing.
Yeah, tell us.
We call that buying a listing. Yeah, I mean, I think that what happens is just like appraisers, brokers go out and they look at trailing data. You look at sale comp data, and you try to make your best judgment call as to what this is going to trade for, and you're looking in the rearview mirror. You're not, it's not really indicative of where the market is right at this moment. And so you have to be forward thinking. And a lot of, it's very hard to go to a seller and go, hey, if you would have sold this 6 months ago, we could have got you $1 million more. But since it's today, I think we should list for this. I've had that conversation, and then they go like, it's like, hey, you ready? I haven't seen you sign the listing agreement. Oh, well, we're shopping brokers. It's like, or you're going to wait for a broker who buys that listing and lists it $1 million more. It's like, eventually, either the market will come back and it'll sell for $1 million more, or they'll sell it for $1 million less because they need to sell it.
Yep. I asked a few brokers. I was like looking at their listings, and I was like, I want to buy the deal, but I don't know how to make money on it. Can you tell me how I can make this work?
That's a loaded question.
It's an interesting question to ask.
What do they say?
They say, let me get back to you on that.
So
no,
I'd say this. Buying a listing, our brain goes to, they're just a sales breath, greasy salesman I'm just signing. There's a lot of just ignorance and inexperience that comes from that as well. And so
I think it's a really good move to get listing.
I used to do it when the market was moving up. I've taken listings and I've been like, hey, look, this thing's not worth $7 million. It's worth $6 million, but the market's moving up. Depending on if you need to sell it tomorrow, it's not going to move for $7 million.
Yep.
If you want me to take the listing, you give me 1.5 years to sell it. Maybe we'll get $7 million. We just got to see where the market's going. And eventually, the market comes up and they come down, and we get to 6.5 when we sell. Like I don't know if that's buying a listing or not, but I just set the expectation of like, hey, your number is higher than the market number, and you got to understand if we don't get that number, it's not my fault. I'm going to try to reach, but if we don't get there, we're going to have to readjust. And then you just take in offers at 6 enough times, people go, oh, the market says it's $6 million. The weird thing about real estate is nobody wants to write an offer for $1 million less than list price. So brokers, I think that's really where the low-hanging fruit is you got listings all over the place that are overpriced by 10 or 20%. Just write offers on them. I mean,
I learned that
they need to be softened up.
I had one of my, and I didn't do a deal with this broker. First year in a while, I haven't done a deal with him. He's like, brought a listed property, you should offer on this. It was 125 higher than I wanted to offer, 30% higher than I wanted to offer. Never did. A young broker in my office just actually got it for less than what I said I needed to offer. And then he made $150,000 off it in like 4 or 5 months.
We were working on a deal, Logan and I, earlier this year, and he wrote on it at like, actually I think Dane had a pocket listing.
Yeah.
And Dane said these people want 2.5, I think.
You guys offered?
We offered 2.4.
Yeah, you guys were going to buy it at 2.4.
And then the deal, they didn't accept our offer.
And then they forgot that you offered 2.4.
And now we're closing on it in 2 weeks for 1.9.
Mm-hmm. Yeah, but that's the whole. This happens a lot in markets like this where it's hard to calibrate value. What is value? So in January, we're closing on a house, and we're going to build 4 cottages, closing at $590. Probably 16 months after I made a 9-month delayed closing offer at $700. So I'm closing 6 or 7 months later than what I projected or offered at $110,000 less. One is a cash out offer. One of them was just delayed closing and will entitle it. So at the $110,000 reduction, that pays for our entitlement, holding cost, all that.
So is this distressed?
No.
This is just people readjusting their
emotional people that didn't the house they grew up in. They didn't want to. It's a big backyard, and a retail buyer is not going to buy a big backyard.
So I think this is
not the reality of what you have.
The takeaway from this conversation for me is that sellers that actually want to sell right now are fatigued.
Yeah.
And when you find somebody that just finally goes, you know what, I don't care. Just, I'll take the haircut, just get rid of this thing. You become, like you said, less emotionally attached to that number, like, oh, we've got to hang on to it. And you finally get to the point where you're just like, I don't want to screw around with this thing the rest of my life.
Yep.
Do I think it's going to go back up in the next year? Probably not. Just sell it and let's move on. And so people are coming to grips with the fact their property has been at that value for the last 2 years.
Yep.
They just hadn't come to grips with it yet.
And I'll add another layer to that anecdotal real life scenario. As buyers, you can just be firm. So how do you get your deals in 2025? Just be firm. Just walk away. Don't agree to something you don't want to agree to. So it was a $700,000 9-month extended closing. They didn't offer that. They were they actually put more money into the property, made it worth more. Went into escrow at $650 with I need some extra due diligence. Let me do all this. Give me an extra period of time. Walked away because it was too high. And then the broker always says, well, what price would you get it done at? And that's when I said $590. And then 3 weeks later, it's all right, they'll take your $590. So part of it is reality. Part of it is sticking to it. Part of it is being sincere as you're having it. But it's communication. That's all it is.
So it'll be a buyer's market for a little while.
Longer, yeah.
Maybe for another 6 months or a year. And
what we're not seeing is these weird spikes. You know, we didn't see in 22 and 23 and early on in 24, we saw these values would get really, like, it was a firm seller's market and a and a buyer's market. Now it just feels like we're kind of meh. So I think
no market.
It's not as easy to get those good buys, but they're there and they will be there. You just have to work a little harder.
Yeah, we got to work harder.
Yeah.
That's the answer.
Yeah, in the fall and winter of 22 and the fall and winter of 23, you didn't have to work hard at all. It just...
I think we got a little lazy, maybe a little spoiled with some of the, especially in 2022, there was just, I don't know, there were so many deals going on, we didn't even know what was happening.
It's funny, my dad, I was trying to explain to him, I'm working hard right now because all the crap I bought in 2021. If I didn't buy all that stuff in 2021, my life would be so easy right now. It's like all the stuff I've bought since July of 2022, it's been easy, it's been profitable. You don't have to work that hard to squeeze the juice out of it. It's just low-hanging fruit. I'm still dealing with all the crap we bought in 21. I'm trying to get out of the pipeline.
Top of market.
Exactly.
Yeah. All right. Well, did we answer the question? We got to work harder. We got to look for people who are tired.
You said you're at the point in your life where you're trying to wind down and not work harder, though.
Well, I'm going to make you work harder.
Cool.
I'm not going to work at all.
This is when he just transitions his money making to his brain, not his typing on the keyboard. He gets to dictate to you.
Yeah, you should start doing that.
I'm only going to do voice to text like Mike.
That's all I use too.
No more typing. I don't want my fingers to get tired either.
You know what I realized? I yell at Siri and I compliment ChatGPT.
Oh. Yeah. Is ChatGPT a boy or a girl?
They're all non-binary.
Oh, okay.
Yeah.
I was going to say you're
But
sexist.
ChatGPT just gives me results I want. Siri just always messes with me.
You know, they built Siri now has ChatGPT built in.
Dude, I am noticing
when you do your update, if Siri doesn't know the answer, it'll be ChatGPT.
I'm noticing some good stuff on the updates.
So you're not yelling at her as much because it's ChatGPT.
This is true.
ChatGPT stepping in.
Is that what it is?
That's what it is.
She has made so much fewer errors. I actually the other day said, she's learning me so much better now. And I called her a she. It is learning me so much better now.
It's Mike's girlfriend.
Yeah. She has a lady voice.
Siri, yeah, and it's a feminine with the E. It just sounds like a feminine name to me. Yeah.
Mikey.
I went by Mikey for so long.
All right, we're going to wrap this one up.
Yep.
Okay, guys, have faith. We're going to do a lot of deals in 2025. I think we're excited. We're excited for this period of time to be over with what's been going on the last couple of years. 2024 was actually a really good year too, but it's just been harder. And so I think deals are going deals are going to materialize, and we hope that you're doing more deals because you're listening to Deal Junkies. Yes. We appreciate you guys listening, and please share us if you like this episode, and we'll see you next time.